Okay, so good day to everyone. Today we're going to be discussing working capital and financing decisions. And with this topic, we're basically going to discuss how you're going to manage your current assets, okay, in relation to how you're going to make financing decisions, meaning how are you going to be able to continuously finance your working capital. So to start with, let us first have the chapter outline. So for this particular topic, we're going to be discussing these items. So first, we're going to discuss an overview of working capital management, and we are going to have a detailed discussion of this one in our next chapters. Same is true for our current asset management. We're also going to discuss these items one by one, and we're going to discuss your assets or your current assets such as your cash, receivables, and your inventories. We will be talking about asset financing, meaning how are we going to continuously have enough assets or enough current assets particularly for our operations to be sustainable. Next, we will be discussing long-term versus short-term financing for us to be able to understand what will be the effects of these two financing methods. Next will be the risk and profitability, which will be in relation to also our asset financing. So meaning how will the risk and profitability of your business affect your asset financing decisions later on. And finally, expected value analysis that can be used in order for us to make financing decisions and in order for us to determine which of the long-term or the short-term financing decisions we are going to use. Okay, so let us first discuss working capital management. So when you talk about working capital management, basically, we are talking about how we can finance and manage our current assets. Okay, meaning how we are going to be able to finance and manage our cash, receivables, and our inventories. Sometimes also investments, but basically investments are not working capital, or these are not really part or a usual part of your current assets in your operations. So it is crucial for us to be able to finance and manage our current assets because it is also going to affect our objectives on how we are going to achieve our long-term objectives. And since we are talking about current assets which are essential or crucial to our operations, it also requires immediate action on our part. So, first thing that we need to discuss first is the nature of asset growth. Okay? So, why is it important for us to understand asset growth? Because generally, a business will have a certain level or certain degree of growth, and with this, we need to be able to understand how it is going or how it is working in order for us also to understand later on how we can finance or how we can improve our operations. So, effective current asset management requires matching of the forecasted sales and production schedules in order for us to maximize the earnings potential of the business. Okay? There are also times wherein there will be differences in your actual sales and your forecasted sales, which could result eventually to a negative or positive effect on our operations. At times, if there will be a less efficient actual results as compared to the forecasted results, then there will be an unexpected build-up in our current assets, particularly in our inventory. Because basically, if you are able to sell only an amount that is less than what is expected, then there will be inventories that will be unsold, meaning there will be a build-up in your inventories. Also, if you are not able to collect your receivables, then there will be a build-up in your receivables, and eventually it's going to result in bad debts, and your bad debts will also affect your operations. Okay? So, also, if there will be an actual sales that is higher or that is more than what you expect, then there will be a reduction in inventory, which will also affect your receivables and your cash flows later on. So, of course, at times, you may think that it is best or it is good if your actual sales are higher than expected. But of course, there will also be an impact later on if you are not able to sustain this level of sales, because there will be an effect to your operations. Okay? So, before we proceed, we also need to understand that your current assets could either be self-liquidating, meaning eventually it is going to revert back to cash, or eventually it's going to be used, okay? Or it's going to be consumed if you're going to pay your expenses or pay your liabilities later on. And there are also permanent current assets, meaning these are current assets that will remain in your books, or it will remain in your business. Okay? For us to understand better, let us go first to an example. Okay? So let us assume that this is our working capital. Okay? And this is the result of our operations. So assuming that this will be the income statement. Okay? And with this particular information, at the end of the day, okay, when we try to understand what are the effects of these operations to our current assets, let's try to label them one at a time. Okay? So let's try to check this first. So when you talk about your sales, it is going to affect generally your receivables. So it's going to affect your receivables for a while. Okay? And your cash. Okay. Why is it that this item is going to affect your receivables and your cash? Because basically, if you're going to sell an item, your sales could be either be in the form of cash sales or in the form of account or sales on account or credit sales. Meaning, if you're going to sell an item, it will be a receivable and eventually it's going to be a cash item. So generally, when you try to look at it this way, so your sales should be able to be translated as receivables and eventually cash later on. Okay? When you talk about your cost of sales is going to involve your inventories. Okay? Why? Because if you do not have enough inventories, then you will not have enough resources for you to sell. Okay? Therefore, your cost of sales here is going to be directly related to your inventories. Okay? With that, we now go to gross profit. Okay? And of course, gross profit is just the difference between your sales and your cost of sales. Your operating expenses will now again be related to another item, which is going to be your cash. Okay? So let's just move the item here. Why? Because generally all of your operating expenses will be paid in the form of cash. Okay? Except of course for depreciation and other non-cash items. Your interest will again be in the form of cash. Your tax expense will be cash again. So generally, all of this will be relating to cash. And of course, if you have net income as per or based on our previous discussion, we need to understand also that your net income or your profit should be translated or should eventually be part of your cash flows or part of your collections. In other words, you must be able to collect your profit and translate that into cash flows or translate that into cash. So generally, if you are going to look into your operations, it's basically going to revolve around three basic items or the three important or crucial items of your current assets, which will be your cash, your receivables, and your inventories. So that's what we are trying to say here. Now, if you're able to optimize your operations, then eventually the amount that you collect will add up to your current assets. Okay? And then the increase in your current assets can be used in your operations again. And with the increase in your operations, there will also be increase in your profit or increase in your resources. Okay? To understand further, let us go to the examples here. So this is an example of two types of operations. Okay? So the first one is stage 1, which is the stage of an operation where there is no or limited growth, meaning there will be a stagnant level of your fixed assets because basically you are not going to add any fixed assets and you're also not going to reduce any fixed assets, meaning the resources that you have at the beginning of your operations will be the same all throughout. And this will be talking about your temporary current assets, meaning these are the current assets that will increase, but at the same time it's going to be reduced or liquidate. It will liquidate itself eventually. Okay, so basically you're just going to have a stagnant operation. Okay, you're going to have an increase and then eventually it's going to liquidate and then increase again and then liquidate at the same level. Okay, so initially this can be the results or the status of your operations, but of course this is not the ideal level of operations that we need to have or that we should have. What we need to have is a growth level if you want our operations to thrive, or if you want our operations to become more profitable or more desirable. So what we need to do is to have fixed assets. It is not evident in this area, but generally the level of increase in your fixed asset should increase gradually. Why? Because as your operations increase, you will need additional resources, particularly additional machineries, additional fixed assets, or additional plant assets in order for your operations to be sustainable. Your permanent assets or permanent current assets should also be increasing, meaning you should be able to pile up or be able to accumulate enough permanent assets or permanent current assets that will be maintained by the business as your operations increases. And as you can see, the level of your temporary current assets, okay, meaning your assets that are being liquidated in your operating cycle, should also increase. Why? Because as your operations increase, you will also have an expected increase in your assets, such as your cash, your receivables, and your inventory. So it is going to have a higher level there. Okay? So to explain further, this is what we are trying to say here. So if let's say for example, we have a graph here. I do not have, this is not going to be a straight line. Okay. So let's try to see if I can create a straight line here. I think I cannot. So anyway, if this is the plot of your graph, this is the x-axis and the y-axis. This is going to be this x-axis will be your years of operations. Okay, years of operations, and then your y-axis is going to be your dollars, okay, or your pesos. Okay, this will be the level of income that you're going to have. Okay, so let's have a plot of your results here. Okay, so if we're going to talk about your fixed assets, we do not want our fixed assets to be flat. Okay, we do not want our fixed assets to be flat because we wanted our fixed assets to increase in a fluctuating level. Just assume that this is a straight line. Okay, meaning it's going to increase in a gradual way as your operations increase. Okay, so meaning as your operations increase or as your operations improve, you're also going to invest more in fixed assets. You're going to invest more into machineries in order to contribute to your operations. Okay, also when you talk about your permanent current assets, you do not want your current assets to be stagnant also. In fact, what you wanted to do is to pile up your current or your permanent current assets. You want it to pile up and you wanted it to be higher as your operations continue to increase also, because you're going to eventually use the piled up or the accumulated permanent current assets to expand your operations. Okay, and then finally, you also need to have an optimum level of operations to a point that your temporary current assets is going to have a curve that is increasing, or a curve that is going to have a higher curve or a higher result in your operations, okay, as your company progresses over the years. So basically, if you try to look at it, you wanted to make sure that your first level of operations here, that is found here, is going to get better, meaning your operations here should have a higher result, and your operations here should also get a higher result. Okay, so that's basically what we're trying to say there. So I cannot have a straight line, so anyway, that's what we're trying to illustrate here. So what we're trying to explain here is that your fixed assets, okay, your fixed assets should increase gradually only, okay, because you're not going to add lots of fixed assets at one time. You're going to increase it little by little, okay. Your permanent your permanent current assets should increase, okay, at a pace or at an amount that is going to be reasonable with the growth of your operations, okay. And your temporary current assets should also have a curve, or it should have a level that is going to be on an increasing pattern also. Okay, so that's basically what we are trying to explain there. Okay, so in order for us to support our operations, we also need to understand that it is just like what we provided in the previous slides. There are two factors. We have the fixed asset and your current assets. So as your operations increases, or as you have a more complex, or you have a higher requirement for your operations, then you also need to increase the productive capacity of your factory, let's say for example, or your production line. So in that case, there will be a slow, okay, or a gradual increase in your fixed assets as a result of the investment of additional equipment, and of course you're also going to replace the old equipment. Okay, so basically, as you increase or as you add new equipment, you're also going to retire, or you're going to replace the old equipment. Okay, however, for the current assets, your current assets will fluctuate. Of course, it's going to fluctuate, meaning it's going to go up and go down as a result of your sales, as a result of your expenses, as a result of your production. Okay, so when there is no, or when your level of production is not in an optimal level, then your level of sales will also not be in an optimal level. So what we are trying to do, or what we are trying to say here, is there are situations wherein a company will produce more than what it can sell, and there will be also a situation wherein the company wants to sell more, but it cannot do so because the production cannot produce anymore. Okay, so that is why you need to make sure that the production level and the sales level are always in sync with each other. Okay, so also in relation to that, since if we try to go back to the previous discussion that we have here, in everything that we see here, it will all boil down to the basic item, or the basic content, which will be your cash. Okay, so basically everything will go back to cash. In other words, it is important also for you to make sure that your cash budgeting is also in sync with your production and in your sales. Okay, so your cash budgeting process will involve the correct allocation of funds that will be related to your production, in order for the production schedules to be smooth, or your production runs to be smooth, and in order for you to be able to make sure that you have enough manpower and enough equipment for you to run your business. Okay, also you need to make sure that your cash budget is also in sync with your sales. Okay, or the other way around. Need to make sure that your sales is being done in a cycle or in a pattern in which you will be able to have or to collect enough cash flows that you can use for your succeeding operations. Okay? So it says here, match sales and production as closely as possible in the short run. Okay? Because it is crucial that you sell or you produce enough units for you to be able to meet the demands and have the optimal level of sales. Okay? So by doing so, it allows current assets to increase or decrease with the level of sales, meaning you do not need to finance or you do not need to enter into situations wherein you lack resources or you have unused resources because there are underutilized or overutilized resources. Okay? And it also eliminates the large seasonal bulges or sharp reductions in your current assets, wherein just to give you an idea, there will be times that because you were not able to plan your sales and your production, there will be times that you will have cash that is not enough to pay up your expenses or your liabilities. So what you're going to do is you're going to borrow funds. Okay? And then there will be times also that you have too much cash and you do not know how to or where you're going to put them. Okay? So that's something that is not good in the point of view of a financial manager, because you need to make sure that your cash is actually being utilized or being used in an optimal level also. So we're going to see so let's try to see the level of production and sales of McGraw companies. Okay, so this is our example for this particular chapter. So McGraw companies is actually a publishing company which publishes books, and of course in the publishing of books is actually a seasonal operation, because most of the time the increases in your publishing will be in the third to fourth quarter in preparation for the release of the new editions in the coming years or in the next year. Okay, so of course the influx of your customers or your demand will be in the third and fourth quarter to accommodate all of the new revised books or new editions of the books, and then you need to release them as early as January or earlier, around December, okay, for early releases. So because of that, okay, also the sales and the earnings will be higher in the third and fourth quarters. And due to the seasonal nature of the publishing, this will be the effect. Number one, lenders and financial managers will also need to plan the inventory, okay, because they need to make sure that whatever they produce during the third and fourth quarter will be sold, because they do not want to have inventories of old books, because eventually you will not be able to sell that anymore. Okay, because old editions of books will be obsolete when the new edition comes. Okay, and of course, if you are catering to universities, to schools, and others who need the newest edition of the books, of course you cannot sell anymore the old editions. So they need to make sure that the lenders and the financial managers will plan their inventory in order for them to make sure that it all or these items will be sold. And lack of correct inventory planning can lead to lost sales eventually. Okay, that's why planning of your sales and your production is very crucial. So this is a plot, okay, of the sales and the earnings per share of the company. So as you can see, there is actually an increasing pattern of the sales from one year to another. And as you can see also, the influx of the sales is usually during the third quarter. Okay? And then your earnings also, if you are going to look into the pattern of their earnings, the highest earnings per share is actually evident during the third quarter also. And this is actually a good operations, because if you try to look at their operations here, you can actually see that the growth is actually on an increasing pattern. Okay, and the earnings is also on an increasing pattern. Okay, and this is met or this is going to be met by the company by optimizing the sales and the production. Those are the two key items that needs to be checked or that needs to be given attention by the company. Okay. So this is also another example. So let us see the seasonal pattern of the sales of Target and limited brands. These are also retailers, okay, in the United States. So just like the publishing companies, the retailers also have influx in their income or influx in their demand during the fourth quarters. Okay. Of course, if you try to ask yourself, why is it that retailers usually have higher sales or higher requirements or demands for their products during the fourth quarter? The reason is because the fourth quarter is the time or the season where most of the employees, most of the customers or consumers receive their bonuses, their 13th month pay, okay, and other incentives from their companies, from their employees, okay, and from whatever sources of income they have. So as a result, there will be a greater buying power from these customers, which will result to greater demand for goods or products and even services. Okay, so that's why we need to make sure that these companies also, these retailing companies, are ready or are prepared for the influx of the demand. Okay, so as you can see, so this is the first chart is the chart of Target. Okay, so the blue one is for Target and this one is for limited brands. And then for the earnings per share, the blue one is for Target and the earnings will be for the red one. The red one is, or the pink one is the earnings per share chart of limited brands. So if you try to look at this, both companies will have, if you try to check the graph, they have identical graphs. Okay, because basically you can see that there is an influx of earnings and sales during the fourth quarter, and if you check the growth of the company, that's where the difference comes in. Because if you look into the level of the growth of the company, let's try to plot with Target. If you see the fluctuations, that's actually going to have a higher or a more steep or a steeper incline or increase as compared to Target or limited brands, I mean, where the level of operations is actually stagnant, almost stagnant, because it is in a same level for the past 4 years. This is something that we do not want to see. Why? Because if there is a stagnant or a limited growth in your operations, then it means that you are not able to maximize your operations. So what we need to see is a level of your sales, okay, or level of your operations that is actually increasing, even though it is just a small increase, for as long as it is not stagnant from 1 year to another. Okay? So in order for us to facilitate faster sales, to facilitate the sale, okay, in a particular company, there is, of course, the introduction of what we call point of sale terminal. So of course, all of us have already seen this. Actually, this is not a new thing for us. Basically, when you talk about point of sale terminals, these are terminals that are used or that are using computers, scanners, okay, and sometimes RFID in order for them to identify the price, identify the product, and for it to, or for the company or for the business to be able to sell these items faster. Okay, because if you rely on the old or basically the obsolete way of selling, which is you're going to sell it by manually computing the amount that needs to be paid, then it's actually going to take more time. So if you want to have a faster turnover of our inventories and to sell it faster, then you need to use technology, and the point of sale terminals is actually going to help a lot, not only for the sale but also for the monitoring of your inventories, because it will automatically update not only the sales level but also the inventory level of your company. Okay, so we now proceed to temporary assets. Okay, temporary assets under certain levels of production. So we're going to try to understand what is the concept of temporary assets. Again, there is what we call fixed assets. There are permanent current assets, and there are temporary current assets. And temporary current assets are those assets that will self-liquidate, meaning is either they will be collected back to cash, or if these are cash items, these items will be used again to pay for expenses and will self-liquidate. Okay? So the thing here is for us to have an understanding of how temporary assets are being utilized, okay, in the business. Let's look into an example, which is a motorcycle company. So it says here, based on the information given, the company has high sales demand during early spring and summer, but then there will be a sales drop during October and March. Okay, so that we will be using, or this company will be using, the level production method. Okay, and the result will be level production and seasonal sales combined to produce fluctuating inventory. So this is basically what's going to happen here. Before we move on to this particular data, okay, this is the story here. Most of the seasonal, or most of the companies that has a fluctuation of demand, or a fluctuation of their operations, there will be a decision that needs to be made, and this is how are you going to produce, or when are you going to produce your goods. Are you only going to produce during the peak seasons and stop production during the lean seasons, or are you going to continuously produce all throughout? Now, there will be some who will say that in order for us to avoid producing unnecessary inventories, let's just produce during the peak seasons. Okay, so that's one decision. Second decision is for us to get the total demand and produce at uniform levels from each month, or for each period, and then the inventories will eventually just sell themselves, okay, during the peak season. Okay, so these two options can be done, but the problem for the first option is that what if the production capacity of your business cannot accommodate the total needs or the total demand during the peak season? Okay, so basically that's going to be the problem here. So this is what we can do. So we can do the second option, which is to produce inventories at uniform levels, and then it will self-liquidate eventually when the peak season comes. So these are the expected sales level from the first quarter until the fourth quarter, and their first quarter is October, okay, because they are not operating under the calendar year, they are operating under the fiscal year. So basically these are their sales, 300, 150, 50, and then 0, and then the peak will come in May, June, July. Okay, basically because you're selling motorcycles, so no one would like to ride in motorcycles during the winter season or during the rainy seasons. So most of them will have motorcycles during the hot or the summer season. Okay, so that's why there will be a peak of sales during these periods. Okay, so generally what are they going to do? So the first thing that they're going to do is to since the problem, or since this example stated that they are going to have level production, okay, so meaning they are just going to produce a uniform level of, or a uniform number of units of motorcycles from each, or for each month, and then eventually, yes, there will be a pile up of inventory levels during the lean season, but eventually it's going to be sold when the influx of the demand comes in during the peak season. Okay, so this is a good strategy, particularly if your products are products that are non-perishable, meaning you can stock them up and they are not or they can still be sold at the same amount or at the same or without their quality being reduced or their quality being diminished. Okay, so this is a good example. So basically, you're just going to produce 800 units all throughout. Okay, so there will be an increased level of inventory for the lean seasons, but then at least from the time that the peak season comes in, you have enough inventory to sell, and at the end of the year you still have enough inventory in preparation for the succeeding periods. Okay, so this is a good strategy. Okay, again, from here, what's going to be the effect? Of course, there will be an effect on your sales, there will be an effect on your cash receipts, an effect on your cash payments, and there will be total effect on your cash balance. So with that, we are not going to go through with the details, but basically, if you want to check the items, you can actually see that there will be a difference in your level of operations, particularly in your sales, okay, and of course your collections. So from there, let's have the summary. Let's just ignore these items. These are actually just the assumptions that are being used to compute for the items, but this will be eventually the actual results there. So from October until September, so October of the previous year until September of the current year, so your cash, receivables, and inventory will have this particular amounts. Okay, so from there, your total current assets will be this amount, okay, for October until September. For us to look into the results, let us look at the graph. Okay, now here, this will be the amount on October, and this will be the amount October of the succeeding period, and then this will be another period. So basically, if you plot the data, and this is going to be our basis of determining whether there is actually a growth. Okay, so if you try to look at that, this is the level of your, I'll just put a highlight here. So this is the level of your permanent, okay, this is the level of your permanent current assets during October of the previous year, or the start of our year. And then October succeeding, this is going to be the October, so this is going to be the level of our permanent current assets. And then at the end of the third year, this is already the level of our permanent. Okay, so if you try to look at it, and we try to see the fluctuation, the line is not straight, but if you look at it, there is actually an uptrend, or there is actually an increase on the level of our permanent current assets. This line now, okay, this one is actually the fluctuation of your temporary current assets. Okay, where is the plot of the fixed assets? Of course, there will be no item there, because we are simply talking about your inventory, your cash, and your receivables. So at least if you look into the asset growth, you can see that the operations is actually being optimized, because there is an increase, or there is a growth in the operations of the company. If we see other graphs, and if the plot is like this, meaning the level of the permanent current assets are the same all throughout, then there is no growth, and this is not something that we want to see in our business. Okay, so with that, looking into the operations, okay, if there is no growth, meaning the level of your cash flows here is the same until the succeeding, okay, and this is something that we do not want to see. What we want to see is there will be an increase in your there will be an increase in your current assets, particularly your permanent current assets from one period to another. Okay. So with that, let us proceed to our patterns of financing. Okay. So it's like this now. So we already understand that in order for us to have an optimal operation, we need to focus on three items, which will be fixed assets, permanent current assets, and temporary current assets. And in order for us to manage these items, we need to also determine how we are going to finance, or how we are going to fund, or where we are going to get the funds that are needed to manage and to finance these particular assets. Okay? So with that, let's look into the pattern of financing. Okay. So there will be certain external and internal sources of funds, okay, that are going to be important in our decision later on. And the pattern, okay, and the appropriate pattern of your financing must be able, or must be matched with the asset build up and the length of financing pattern. Okay? So the ideal, okay, or this is basically applicable for big companies or the stable companies, it's going to be this particular pattern. Your fixed assets and your permanent current assets will be financed by long-term financing, meaning by your long-term debt, talking about your bonds, okay, loans, okay, and other long-term debts, and equity, which will be coming from your shareholders or your owners. And then your temporary current assets will be financed through short-term financing, meaning you're just going to have short-term loans, or you're going to have internal financing. Okay? So that's basically how you're going to do that. Okay? However, there are also situations wherein we cannot do the ideal, okay, because of certain limitations or certain alternatives that we can also use. Okay? So we need to consider, number one, the challenge of constructing a financial plan is to prioritize the current assets into temporary and permanent. Okay? So basically, what we need to understand is, if we look for financing plans, we need to understand that your current assets, a portion of it is temporary and a portion of it is permanent. So if you're going to finance your assets all into short term without considering that some should be permanent, then your financing plan might fail. So that's why your permanent current assets should be financed on a long-term basis as a general rule, and your temporary current assets should be financed on a short-term basis. Okay? Also, we need to consider the exact timing of asset liquidation, even in the light of ascertaining dollar amounts is also onerous. Why? Because basically it's like this. What if we decide that we are going to finance our permanent current assets using short-term financing? And then that was going to happen. Eventually, if you need to pay up the debt that you incurred for the financing, but you do not have enough cash, you do not have enough resources, so that's going to result in another problem there. Okay? And it is also difficult to judge the amount of short-term and long-term financing available, particularly in situations wherein you do not have enough networks, you do not have enough connections, and you do not have control over the economic situation. Okay? Meaning, you cannot simply choose between short-term and long-term financing, okay, the way you wanted it to be, because particularly in tight economic condition, most of them, or most lenders will resort to short-term only, not long-term, because they wanted to have their money back at a faster rate or on a shorter period. So we go to long-term financing. Okay. What's going to be the basic concept of long-term financing? Long-term financing is basically borrowing funds on a period that is more than 1 year. Ideally, that's around 5 to 10 years, okay? or generally at a mid-range, that's going to be 5 years. Okay? So you're going to have long-term financing for debt, okay, or long-term financing for equity, meaning you're going to get resources from your investors. Okay? So it is good, okay, for you to use long-term financing because you can hold on to your borrowings, or you can hold on to the funds on a longer period, okay, while using them for short-term needs. Okay? And generally speaking, long-term capital can be used or will be used to finance your fixed assets, your permanent current assets, and a portion of your temporary current assets. A portion, why? Because a portion also of your current assets or your temporary current assets will be financed through short-term financing. Okay. So this is going to be another alternative. So your your fixed assets, your permanent current assets, and a portion of your temporary current assets will be financed on a long-term basis, and the remaining portion here will be financed on a short-term basis. That's another alternative. If you try to look for short-term financing, then what you're going to do is, particularly this is for small businesses. Small businesses do not really have access to long-term financing. Why? Because most of the time, banks and other financial institutions cannot or will not allow small businesses to borrow on a long-term basis, particularly if their credit standing or their credit rating is not yet that credible or not yet that reliable. So most of the small businesses will rely on short-term financing or trade credit, okay? Meaning they're only going to rely on borrowings that has a period of 1 year or less. Okay? So the advantage of short-term financing is you can borrow at a lower interest rate, but then the disadvantage is you need to pay the borrowing on a shorter period of time. So short-term financing or short-term borrowings are generally used to finance your temporary current assets and a portion of your permanent working capital. So this is going to be another alternative. So your fixed assets will be long-term. A portion of the permanent current assets will be financed on a long-term basis also, and a portion of the permanent current assets and the temporary current assets will be financed on a short-term basis. So this is another alternative. So the only thing that we can be sure of is your fixed assets will always be financed on a long-term basis, and your and your temporary current assets will generally be financed on a short-term basis. Okay, but a portion of this can actually be used either long-term or short-term. Okay, so with that, what will be our concern here? The main concern with your long-term and short-term financing is actually the interest rates. Okay? So, and in order for us to determine the interest rates, we are actually going to look into the yield curve. Okay? So, the yield curve shows the relative level of short-term and long-term interest rates for us to have an idea of and assist us in our decision making later on. Okay? So, this is generally in the US setup. There is what we call government securities. Also in the Philippines, we have these government securities. There will be corporate debt, or basically the borrowings that we have from private institutions. And there will be yield curves for short terms or short-term items. And it's also going to reflect the curves of your inflation, okay, and changes also in economic condition. So the basic theories that supports your yield curve are the following. First is the liquidity premium theory, which states that long-term rates should be higher than short-term rates. Why? Because if you lend, or if a certain creditor will lend on a long-term basis, then this lender will not be able to recover his capital it will only be able to recover his or her capital on a longer period, meaning there will be more risks, okay, or more risk related to the lending on a long-term basis, meaning there should be a higher interest, okay. While on the other hand, short-term borrowings should have a lower interest rate because number one, there will be a shorter period of time for the borrower to use it, and number two, there will be lesser risk, okay, associated with the borrowing because it is also on a short-term basis, okay. Second theory is the market segmentation theory, which states that treasury securities are divided into market segments by the various financial institutions investing in the market. In other words, the securities or the borrowings or the amount that can be borrowed from the market, either from the government or from the private institutions, are divided into various industries, various financial institutions, okay. Okay, and basically meaning it is going to be distributed to various individuals and various institutions in the market or in the economy. Okay. Third is expectations hypothesis, which states that yields on long-term securities is a function of short-term rates. Meaning, those who are lending on a long-term basis is actually creating or determining their interest rates, okay, based on how short-term lenders are charging, okay. So that's why there is also a relationship between your short-term and your long-term debt, okay. So this is a graph that tries to explain the relationship between your long-term and short-term financing, and as you can see, basically the movement of the fluctuations are almost similar with each other, okay. So that's why although the rates may be different, the pattern or the movement are actually similar, okay. So this is the relative volatility of our interest rates, okay, and also this is in relation to the consumer price index. So let's look into our alternative financing plan. Now that we know that we can borrow on a long-term or a short-term basis, let's try to see what's going to happen if we go into certain alternatives. So our example for this problem will be Edwards Corporation. Edwards has two plans. Plan A is to borrow on a short-term basis. Okay, so this is going to be for the current assets. So for the current assets, for Plan A, everything will be borrowed on a short-term basis, and then for the fixed assets, it's going to be long-term. And then for Plan B, a portion of your current assets will be financed using short-term and long-term, and your fixed assets will be financed solely on long-term basis. Okay. So as a result, this will be the total financing. Okay. So this will be the summary. So what's going to happen? Let's try to see what's going to happen. Under Plan A, okay, if on a certain level of operations, which is going to be 200,000, under a short-term plan, or under Plan A, which was shown in the previous slide, the earnings after tax has an 80,000 earnings after tax result, and then under Plan B, the earnings after tax is only 73. So in a way, you can say that Plan A is better than Plan B. Okay? So but this is only for 1 year. The question is what's going to happen in the succeeding years. Okay? So which is going to lead us to the next topic, which is the varying condition. Why? Because just like what we said, there will be varying conditions in our economy which will lead to the changes in interest rates and changes in the capability of lenders or creditors to lend on a long-term or short-term basis. So this could be explained by two concepts, which is number one, the tight money periods, just like in our situation right now, wherein capital is scarce, making short-term financing difficult to find and may ensue very high rates. Okay, so if during tight money periods, there is a possibility that you cannot borrow any funds, and if you can borrow funds, the rates will most probably be higher. And inadequate financing may mean loss of sales or financial embarrassment, meaning there will be a possibility for businesses to close, for your operations or for your company to reduce its operations. And this is actually evident during this year because of the pandemic that's actually happening. Also, there is the expected value concept, wherein there is a certain probability that we are going to consider, and if we sum up all of these probabilities, we will be able to have the expected outcome under certain situations. So, as an example, how much will be the expected return if we are going to have this particular situation? Okay, so number 1 is under normal condition, and number 2 is under tight money condition. So with the probability provided, meaning there is an 80% probability that the company during the year will operate under normal conditions and 20% under tight money conditions, the expected outcome is still a positive outcome of 2,600. Okay, so this is based on the probabilities provided. Again, these are given items, so we do not have an actual date of where they got this. Okay, so the expected value, okay, for plan A versus plan B, okay, under certain conditions is positive 2,600. So meaning this is still a good situation for the company. However, what if the expected return, okay, is actually going to be detrimental to the company? So an example, based on this information, under normal conditions, XYZ Corporation will have an expected return of $7,000 during for plan A, and it has an 80% probability, so you will have an expected outcome of 5,600. However, during tight money situation, the expected return under plan A is actually a loss of 50,000, and it has a 20% probability. So as a result, there will be a negative expected return for plan A versus plan B. Okay, which means that it is not desirable for you to use plan A. Okay, so that's basically what this is trying to say. So it means that your financing decisions later on should also consider, or should also take into consideration, the risks that are associated with the probable results, okay, based on the economic condition or the situation that's coming up or that's going to be expected. And you're also going to consider the different probabilities. Okay, and finally, before we move on, we also need to consider that a firm should be able to have its operations and make sure that it is moving towards optimal policy or optimal operations, wherein there is an attempt to relate asset liquidity to financing patterns and the other way around. And also, they need to be able to decide how it will be able to combine asset liquidity and financing needs, meaning your operations should consider the risk-oriented, or your firm should be able to either be risk-oriented or conservative, depending on what is expected or what they are trying to expect. So, let's skip this one. This is not actually needed. This is just an example of the net working capital. Okay? And our final consideration will be this one. As part of your financing decision or your financing plan, you could either resort to short-term or long-term. And also, in your decision, you need to consider that there will be associated risks, okay, in relation to your decisions, or in relation to what you're going to use. So, under short term, there is under the low liquidity and high liquidity level, and there will also be long term under low liquidity and high liquidity areas. So you're going to make decisions later on based on what you are seeing here. Okay, so we'll have additional discussions with this one on the on our next video. Okay, so that's it for now.